Most investors believe they understand how corporations work. They believe good companies are run by good managers, that high credit ratings means good stewardship, and that stock buybacks reflect confidence or discipline. But none of that is how modern corporate America actually works. Welcome to Markets Without Spin. I'm Franz Amundsen. This show exists for one purpose: to cut through the polished narratives and explain what really drives corporate behavior, the incentives, not ideology, not PR, incentives. If you want to understand why safe companies become dangerous, why buybacks enrich insiders at the expense of long-term strength, and why great companies collapse seemingly overnight, then you have to look past the surface and into the architecture of decision-making. Today we're going to look at how incentives can quietly hollow out even the strongest corporation, including two corporations that once seemed untouchable: Montana Power and Boeing. Both carried reputations for discipline and reliability. Both inherited fortress balance sheets. And both were destroyed when incentives shifted, especially when incentives tied to earnings per share, short-term total stockholder returns, and stock buybacks. Let's start with the foundation every investor misinterprets: credit ratings. Investors often see AAA or AA credit ratings and think, management must be outstanding. These people really know what they're doing. But that's not what a credit rating measures. A credit rating is not a score for today's executives. It's a legacy score built by the decisions of previous generations. A AAA rating reflects decades of conservative leverage, decades of disciplined capital allocation, decades of financial stewardship, and decades of leadership that valued long-term stability. It's the financial equivalent of inheriting the family farm. You didn't build it. You're simply fortunate enough to manage it. And that's where investors get blindsided. Because when new executives inherit a fortress balance sheet, they also inherit room to make mistakes, room to hide short-term decisions, and room to erode long-term value without immediate detection. A AAA rating doesn't prevent bad decisions. A AAA rating absorbs bad decisions for a while. By the time the rating agencies or analysts realize the culture has shifted, the damage is already done. And nowhere is that clearer than in a company that wants to find stability for thousands of ordinary investors, including my own family. In the 1990s, the Montana Power Company was one of the safest, most conservative utilities in the northern United States. Stable cash flow, dependable dividends, minimal leverage. This was the kind of stock retirees held for generations. My own parents owned Montana Power shares. They bought it, collected the dividends, and slept well at night. Until around 1999 to 2000, new leadership came in with very different incentives. They weren't content running a boring, reliable utility. They wanted to chase the telecom boom. So they made one of the most catastrophic capital allocation decisions in modern corporate history. They sold nearly the entire regulated utility, the power plants, transmission lines, and distribution assets, and rebranded the company as a telecom firm called Touch America. Instead of the predictable returns of a utility, they bet everything on fiber optic dreams at the peak of the dot-com bubble. Within a few years, revenues collapsed, debt piled up, the telecom market cratered, and by 2003, the company was bankrupt. A century of stewardship was wiped out. What happened? Incentives changed. The leadership that built the company prioritized stability, safety, and consistency changed. The new management prioritized growth optics, bold narratives, and personal reward. Montana Power didn't collapse because its fundamentals changed overnight. It collapsed because new executives inherited a fortress balance sheet and treated it like a piggy bank for risky bets. That's the pattern, and it's not limited to utilities. It's not limited to the past. It's happening at some of the most iconic companies in the world. And no company illustrates this more clearly or more tragically than Boeing. For decades, Boeing was the crown jewel of American engineering. The Boeing 707 revolutionized air travel. The Boeing 747 became an icon of global commerce. Boeing was known not for financial engineering, but for engineering excellence. Executives came from technical backgrounds. Safety wasn't a metric, it was identity. Then in 1997, Boeing merged with McDonnell Douglas. And with that merger came a different species of executive. McDonnell Douglas had survived not by building the best aircraft, but by mastering cost-cutting, accounting maneuvers, government contracting politics, and short-term metrics. Its most influential leader, Harry Stonecipher, famously said, "We are in the business of making money, not airplanes." His philosophy seeped into Boeing leadership ranks, and then came the symbolic movement that told engineers everything they needed to know. In 2001, Boeing moved its headquarters away from Seattle, the heart of its engineering culture, to Chicago. The engineers stayed behind. The executives moved thousands of miles away. It was a cultural divorce. From that point forward, Boeing was increasingly ran by executives who came from finance, came from consulting, held MBAs, had limited or no engineering background, and were trained to optimize metrics, not machines. Leaders like former General Electric executive and Harvard MBA Jim McNerney and later Dennis Muhlenberg oversaw an era in which Boeing reduced R&D as a share of revenues, outsourced engineering work, emphasized margins over design refinement, pressured suppliers, and tied executive compensation directly to earnings per share and total stockholder return. During this period, Boeing spent over $40 billion on stock buybacks. That money could have funded new airframes, improved training, or strengthened safety systems. Instead, it boosted earnings per share, short-term total stockholder return, and executive compensation packages. The old Boeing reinvested profits into engineering. The new Boeing paid executives based on share price movements. And the result was a 737 MAX, a design rushed to compete with Airbus, optimized around cost and speed, not safety. When the crashes happened, the world asked, how could this happen to Boeing? But anyone watching the incentive structure could see it coming. Boeing didn't fail because it got unlucky. Boeing failed because it stopped being led by engineers. It failed because incentives changed dramatically and intentionally, just like Montana Power, just like every company where stewardship is replaced by extraction. At the center of these collapses lies one tool: stock buybacks. Buybacks are not a sign of financial strength. They are not a vote of confidence. They are not a sign that management believes the stock is undervalued. In today's corporate landscape, buybacks are the easiest, fastest way to manipulate earnings per share, total stockholder return, option vesting, performance awards, and short-term stock price optics. Executive pay packages are overwhelmingly tied to those metrics. So management pushes the buyback button because earnings per share goes up, TSR improves, grants vest, bonuses hit, dilution is hidden, and the stock price pops. Meanwhile, reinvestment declines, product quality slips, balance sheets weaken, and long-term value erodes. Buybacks are the financial accelerant poured onto a misaligned incentive structure. Montana used its balance sheet to chase hype. Boeing used its balance sheet to chase earnings per share. Different industries, different decades, same mechanics, same destruction. When you put all this together, the pattern is unmistakable. Credit ratings reflect past discipline, not present behavior. Boards often reward short-term optics over long-term value. Executive compensation makes financial engineering more profitable than engineering itself. Buybacks make these distortions invisible until it's too late, and great companies often look healthiest right before they fall apart. If you want to understand corporate behavior, don't start with earnings calls or mission statements. Start with incentives. If you want to understand why wealth keeps concentrating at the top, don't start with tax policy. Start with buybacks. And if you want to know whether a buyback is good, just ask the simple question that matters. Who does it really benefit? Because most of the time it's not the employees, it's not the new investors, and it's not the long-term shareholders. It's the insiders who control the incentive structure. In our next episode, we're going to look into the opportunity cost behind every buyback, the reinvestment, innovation, acquisition, and debt reduction that doesn't happen. And if you want to understand where corporate America is headed, you have to understand what it's choosing not to build. If you enjoyed this episode, please follow the show, leave a rating, and share it with someone who cares about markets, policy, or how corporate incentives really work. Your support helps the show reach more people, and it helps bring transparency to the places where it's needed most. That's the end of this episode. See you at episode 2.